Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Micron technology.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis.
Okay, so we're jumping straight into what feels like one of the biggest stories in tech right now.
It really is.
This company is. I mean, it's right at the heart of this whole AI build-out. But historically, it's been, just plagued by these brutal cycles.
The boom and bust, yeah.
Exactly. So the real question for us today is this time different? Have they finally broken free from that? Or is this just another boom waiting for the bust?
That is the multi-billion-dollar question.
Let's start with the financials then. What is actually driving this massive earnings inflection people are talking about?
Right. So the core bullish case, it really all comes down to pricing power, specifically from AI memory, high bandwidth memory, or HBM.
Okay.
This isn't the old volume game anymore. It's a high-value, high-margin game now. If you look at their latest numbers, for Q4 of fiscal 25, they were exceptionally strong.
How strong?
We're talking revenue around $11.3 billion, and EBITDA, that key measure of operational profit, was at about $5.9 billion.
That's a huge number. But the metric I'm always watching with these guys is gross margin. That's the one that used to just collapse.
And it's snapped back dramatically. We're seeing it rebound to nearly 40%.
Wow.
And for anyone who follows the space, that's a huge historical signal. 40% gross margin is usually that tipping point where the business goes from, painful to having incredible leverage.
Because of the high fixed costs, right?
Yeah.
Building those fabs is just insanely expensive.
Precisely. So every extra dollar they get from higher prices flows almost entirely to the bottom line. You get this magnified profit growth.
Yeah.
And it tells you that HBM and advanced DDR5 are fundamentally changing that whole profitability curve.
So if that's where we are today, what does the momentum look like going forward? Are analysts thinking this can continue, or is 40% the peak?
Analysts are being aggressive, but will have their reasons. For the first quarter of fiscal 26, the consensus is expecting an EPS of $3.79.
On what kind of revenue?
On over $12.6 billion in revenue. So that implies, 45% year-over-year revenue growth? And more than double the EPS growth year over year.
So it's still accelerating.
It's an accelerating cycle, yeah.
Yeah.
That's why you hear everyone calling it the AI supercycle.
Okay, the numbers look great. But here's the structural question for me. Why is the pricing so strong? And can it last? I mean, memory companies have always been their own worst enemies, right? They eventually flood the market with supply.
And that's what's so fascinating this time. Management is consciously behaving differently. They've explicitly guided that their bit supply growth for calendar 2025 will be below industry demand growth.
For both DRAM and NAND.
For both non-HBM DRAM and NAND, yes, they are deliberately holding back. It's scarcity by design, it's a fundamental shift from past cycles.
So management is keeping the spigot tight. That's a massive change. What is the street predicting for prices then, because of that tightness?
It's leading directly to, skyrocketing prices. The commentary suggests we should be ready for robust double-digit price increases for both DDR5 and HBM in the next few quarters.
Double-digit.
Some firms are even modeling price peaks that could go higher than what we saw back in the 2018 memory cycle. And if that happens, the profits would be just enormous. It would easily justify those forward projections.
That really grounds the financial side of it. Okay, let's pivot to strategy, because this discipline, it's not just about capacity, it's about which capacity, right? They're moving away from some of their older segments.
Absolutely. The pivot is key to escaping that old trap. They're getting out of the lower margin crucial consumer business completely by February 2026.
So no more simple memory sticks for PCs.
Exactly. And that's not just cutting costs. It's a calculated move to reallocate that high-end manufacturing capacity straight into high-value AI server memory. They're shedding the parts of the business that caused all the pain during the down cycles.
But wait a second. Exiting crucial. That means giving up reliable revenue, even if it's low margin. Isn't that a big risk if the AI cycle slows down even for a minute?
It is a risk, but it's a bet on the long-term structural shift. You have to remember their advantage. They are one of a three-player oligopoly in DRAM.
With Samsung and SK Hynix.
Right, and in an oligopoly, when demand for something like HBM spikes, those three companies get to dictate the price. Their whole moat is built on tech leadership and the insane amount of capital it takes to play. If you can't spend billions, you're not in the game.
And speaking of billions, They are putting their money where their mouth is.
Yeah.
What's the scale of this new investment and how are they handling the risk?
The scale is staggering. It's a 1.5 trillion yen, so roughly 9.6 billion US dollars investment just for HBM in Japan. But here's the smart part. That immense investment is heavily supported by Japanese government incentives. So they're essentially externalizing a big chunk of the cost.
So they get the capacity without putting all the strain on their own balance sheet.
Exactly. It lowers the financial and execution risk of such an aggressive move.
That is smart. But AI isn't just in the data center. Where else are they extending this moat?
They're pushing hard into automotive and edge AI. Cars are basically becoming data centers on wheels. And they need specialized super-fast memory. Micron just started shipping these automotive UFS 4.1 solutions, which double the bandwidth to about 4.2 gigabytes per second.
Which you need for autonomous systems processing all that sensor data.
You absolutely do. And these are the kinds of differentiated products that are much harder for other players to replicate at scale. It cements their margin advantage.
So they've got the focus, the tech, the government backing. Is their balance sheet strong enough to support all this, especially with that CapEx spend?
Their foundation is very robust, which is key. Their last 12 months free cash flow was about 2.2 billion, and that's expected to ramp up toward maybe 10.6 billion by 2030 if this cycle holds.
And their debt.
Relatively low debt to equity ratio. So they have the stability and the flexibility to fund this massive pivot while, still being able to return capital to shareholders.
Okay, moving on to market sentiment. We have to talk about the stock's run. I mean, it soared somewhere between, 170 and 180% year-to-date in 2025?
It's been breathtaking.
From a technical perspective, does that kind of vertical move worry you? Are we looking at a blow-off top?
It's interesting. Technical analysts are actually looking at the recent action very favorably. Despite that move, we saw that huge 40% surge in September after the AI pivot news.
Right.
But since then, it's been trading, relatively flat. And that isn't seen as a bad thing. It's seen as constructive consolidation.
Okay, explain that for us. What does constructive consolidation actually mean? Why is trading sideways a good thing here?
Well, when a stock moves that fast, that vertically, it needs to kind of pause and take a breath. It lets the gains get digested, shakes out the short-term traders.
I see.
And constructive consolidation is when it trades sideways without breaking down. The key is the overall trend is still intact, higher highs and higher lows. It's trading comfortably above its 50-day and 200-day moving averages.
The classic setup.
It's a classic setup for a healthy, long-term momentum phase. So the charts are signaling more of a bullish reset than a warning sign right now.
That makes sense. What about Wall Street's confidence? Are the big institutions still backing this, even after it's basically tripled?
They are, and that institutional conviction is a huge factor. You see the big brokers with price targets clustering between $300 and $325.
Which acts as sort of a psychological magnet.
It does in a momentum market, for sure. And you see money still flowing into the whole AI semi-space. Critically, there's no alarming insider selling. The people who know the company best, they're holding on.
Which suggests they think there's still a lot of runway left.
Yeah. That's the signal, yeah.
Okay. So far, this is an overwhelmingly positive story. High margins, smart strategy, strong technicals. But there's always a but. Let's talk about the bear case. What's the number one risk here?
The primary risks are still the same two ghosts. Cyclicality and valuation.
Even with all the changes.
Even with the changes. At its heart, memory is still a commodity market, and the constant threat is your competition. If Samsung or SK Hynix decides to flood the market to fund their own HBM plans, it could hammer prices.
And bring those 40% gross margins right back down.
It could. Or, if there's some unexpected pause in AI server builds because of the broader economy, you could get a supply glut pretty quickly.
And what about the valuation risk? The stock's moved so far so fast.
That risk is substantial. The stock is trading at a very large premium to a lot of conservative estimates. One DCF-based analysis I saw suggests the price is about 134% above fair value.
And what does that mean in practical terms for our listeners?
It means that years of future AI growth are already priced into the stock today. There's basically no room for error. If growth disappoints even a little, or if the cycle turns sooner than expected, that premium valuation could lead to a very severe, very rapid drop.
That also brings up execution risk, doesn't it?
Yep.
That $9.6 billion Japan investment, that's a huge, complex project.
Execution is absolutely paramount. There are risks with yields, timelines, customer qualification, And yeah, exiting the crucial business has short-term transition costs.
So how do they mitigate all that?
Well, you have to connect it back to what we discussed. That guidance on restrained bit growth is their main defense against a price collapse. The government support for the Japan fab de-risks the balance sheet significantly.
And the pivot itself.
And the pivot itself. By focusing on high-margin AI products, they are structurally less dependent on those volatile PC and phone cycles. They're managing the risk by choosing to play in the part of the market where their oligopoly status gives them the biggest shield.
Okay, so assuming they navigate those risks, what are the near-term catalysts we should be watching for? What could push the stock toward those $300 targets?
The next big one is the Q1 fiscal 26 earnings report for the quarter that ends in November 2025. Consensus is already super aggressive, remember?
379 EPS.
Yeah. So if they manage to beat and raise guidance on those already high numbers, especially if it's because of better than expected HBM pricing, that would be a massive catalyst. It would likely trigger the next wave of institutional buying.
And outside of earnings, what other news should we be watching?
You want to see continuous updates on that Japan HBM fab, news that construction is on time, that yields are looking good, that reinforces the long-term story.
Any partnership news?
Yes. Always listen for rumors and then hopefully confirmation of deeper supply partnerships with the big AI chip designers. Think NVIDIA or AMD. If one of them locks in a major multi-year supply agreement, that could move the stock significantly all on its own. It guarantees volume and pricing for years to come. So if you step back and look at the whole thesis, this is, without a doubt, a core picks and shovels play on the entire AI build-out. The earnings inflection is real, the strategy is sharp, and their supply discipline is just. It's beautiful to watch.
So what does that mean for you, the listener, trying to fit this into your own financial picture?
It means this shouldn't be seen as just a tactical quarter-to-quarter trade. This is a structural, multi-year hold. You're thinking 2 to 4 years, maybe more, to really capture the full HBM adoption curve.
You had to be prepared for volatility.
Volatility is guaranteed with that premium valuation. But tactical pullbacks, especially ahead of earnings, should probably be viewed as opportunities to add to a position, not as a signal to sell. And maybe the thought to leave you with is this. If the market really believes this memory supercycle can surpass the 2018 peak, what other historically cyclical companies might be next to claim they've finally escaped their past?
That is a clear thesis and a really compelling question. Thank you for walking us through the financials, the strategy, the technicals, and those critical risks. If you found this discussion useful, be sure to subscribe for more market intelligence. We wish you luck on your smart wealth journey.